Vince says, is it valid for the radioactive married put structure to use a 2-year out leap deep in the money to replicate stock ownership? Example, I want a strategy of Apple, but instead of having to buy 100 shares at the price of $38.50 or $38,500, I want to buy the September 220 leap with a delta for $17,000. Okay. So I don't know which question you're asking, Vince, because there's 2 questions wrapped into that, and it all comes down to the terminology. What do I mean by that? I'm going to use the search by symbol tool first. We're going to go to Apple. And you said the 2022 September, is that correct? All right, yes you did. Great. Okay, so AAPL, September 2022. Now, I'm looking for a married put, I understand that. But if I was opening a married put today, this far out in time to September of 2022, I am right where I want to be. Stock's at 370. The risk is higher than I would like, but because we're going 748 days out in time. So when I'd normally take a risk of about 7%, I'm going to double that because we're going 748 days out in time. 784 days, excuse me. Balance between these two. Really want to go with the 390 for the 14% risk, but I think I'm going to have to stick here with a 380 at 15.4. Okay? For 2 years, 784 days, a risk of 14.9% on this married put position. Okay, so let's take that to the average of what? 7.4, 7.45, 7.5% per year. Perfect in my wheelhouse, what I like to see. Okay, so I'm doubling up the time. I'm putting up $44,646 to risk $6,646 at the 14.9%. Okay, and there's 2 thoughts on this. You want to supplement this with this deep in the money 220 strike leap. Okay? What you're going to create is called an in the money long strangle if you do it in this fashion, meaning that you're trying to substitute the stock with the long call, the leap call deep in the money, and you're keeping the same put. That creates an in the money long strangle. I've got to jot down my break even. Now that's at expiration, of course, but to be fair, we'll say that. The break even at expiration for my position is 6.46. All right, let's clear out the stock. September 2022, 220 strike call, 5-point bid-ask spread, not elephant man bad. Okay, so we can probably get that in there. $61, $63 or so. Oh, I'm sorry, $162, $163, not 62 or 63. Okay. What was my maximum monetary risk on the married put position, Vince, that yes cost me $44,000 versus your $23,000? It was $6,646. Okay, so we're increasing our risk by about $1,200, and we're also risking 32.8%. And that's if the stock is within these range. Now that's 2 years away, I know, but I'm giving you the overall view of what you should be looking at in this scenario. We never advocate doing this in the money long strangle compared to the married put. I've got other webinars on that, Vince. I'll try to find let me jot this down, Vince, real quick. William's question in there, and then there was another Vin. Okay, I'm writing down the order here, but Vince, ITM Long Strangle versus married put. Okay, all right. So what happens here? Now, yes, this is looking way out in time. You're going to be able to maybe do adjustments, sell premium against the long call, just as I could in the married put position. You lowered your cost, but you increased the risk, and your percentage risk is double mine. Right, I was at 14.9% or whatever. Yeah, 14.9%. You're at 32.8. This death valley is what we call it with these straddles and strangles. Strangles that are too far at a time, or these in-the-money strangles that are too wide apart. It's death valley. As the stock sits here and stagnates, you're not seeing any real profit on the position. Okay, you're going to do income methods. You're going to do adjustments, Vince. So am I. But you've got such a much you need a much larger move in the underlying stock price before you start seeing a profit. Now, both of us purchased a 380 put. Okay, that's fine. You did lower your cost basis. That's great. But what is the whole point of this is to reduce risk. It doesn't matter how deep in the money you go and what delta you have with that long call. it's going to have extrinsic value. It's going to have time value. That's going to increase your risk. What are you doing now? You have two time values that you're fighting against, the put and the call. And at the same time, you're not delta neutral. You are delta opposed. Yes, this is 0.91, and this is only at maybe 0.65, the 380 put. Maybe it's even a 0.55, Vince. But what that means is you need a much larger movement upwards in the stock price before you start seeing profit on the position, compared to the married put that, yes, is a large cost basis. I understand that. I appreciate that. But it's not a parity trade by any stretch of the imagination. You're increasing the monetary risk. You're drastically going out of bounds with the percentage at risk, even for a 2-year time frame. And just to show you something, let's say in the next 10 days, let's say 30 days, go back a year. So on 8/24/2020, okay, let's say the stock goes up to 390, goes up about 20 points. Okay, so this here shows you that you're at a profit. I didn't expect that actually, but okay, that's good. So this shows you that you're a profit because the call gained about 2,200, or the 20-point move. It's probably not accurate because the volatility number here, I don't think that's right. You can't gain more on the call with a 0.91 delta than you saw gain on the stock. So the delta, yeah, let's put this back to 0.35. That's probably more accurate as we talk about the volatility again. Okay, but in any case, Vince, that's better. That's much better. Okay, so a profit of 531, 0.316 on the put, 0.35 on the call, because, yeah, I'm not expecting to gain more on the call than I am with a 20-point movement of the stock. That was showing an increase of about $2,400. That's not accurate. This is probably a more accurate volatility of how this leap call is actually reacting, as we saw before. Now, why do I bring that up? Well, you're at a gain here of 531 on this position with a 20-point movement. Okay, you're giving back some on the put. It was about $1,200. So I'm going to lose $1,200 too, and you're gaining $1,759, not the full $2,000, because you're not at a 1 delta. And as we saw in the J.P. Morgan example, it might get to 9.2 or 9.3. It's not going to go to 1. It's not going to go to 0.99 anytime soon, even though you're this deep in the money. Real quick, let's add the stock back in. Okay, and $531 if the stock moved up 20 points to 390 on 8/24/2020. With a profit of 726 on the position. Yes, it's a lower percentage, but I'm gaining a higher monetary value. Yes, you have a higher percentage return because of your cost basis. But what I'm illustrating to you is that a lot of times when we run these examples for customers, and I've done it for years, the comparison of that in-the-money long strangle to the married put, you have a much wider break-even distance. Your upper break-even might be lower, but you have this death valley range where you're losing money and losing time value if the stock's not moving. And in normal market conditions, this might be normal for Apple, Vince, but in normal market conditions when you expect to see a 3, 4, 5% movement in the stock price over a 30 or 45-day period, the married put will hit a profit where these in-the-money long strangles are still lagging behind because they're delta opposed. Now, yours is a little bit better, I understand, because you're using the leap option, but a lot of times investors say, well, Mike, if you're buying Apple at 370 and buying the 390 put for a risk of 14%, couldn't I do pretty good if I just bought the 300 that has a similar delta? Well, now that's where the delta opposed really hurts, because you could have a 2-point movement of the stock and have no value in the position. You're still at a loss. You could have a 3-point movement down, or even a 5-point movement down on the stock, or a 4% or 3% move down on the stock, and you still be delta opposed. You wouldn't be seeing a profit. Whereas if you saw a 3 to 5% movement upwards on the stock, you're likely seeing a gain on the married put position. Okay? So, not the structure I would do. That's not a parity trade. There is buying the call. Okay, so we were talking about using the 380 put to get that risk of 14.9%, or $6,646 if I wrote that down correctly, which is equivalent in number only to just buying the 380 call, meaning about the risk is about 6,400 instead of 64, 66, or whatever it was. But yes, now you're risking 100%. Buying this call is a similar risk-reward profile to the married put I showed you for Apple, but it is not a parity trade, and I think you see why right away. This is not a parity trade at all, because if you only have $10,000 to invest and say, I can't do the married put that Mike did on Apple because I don't have the capital to do it, I'm just going to buy this call. Yes, I put in more capital, but remember, I'm only risking 14% for 2 years. You're risking 100%. If there's a 10% drop in the stock with the married put, I might only be looking at a 2 or 3% loss in the position. There's a 10 or 15% drop on the stock with this call, you might be looking at a 30 to 40% loss on this position. Okay? This is not a parity trade. The only true parity trade to the married put is if you bought the same strike call with the same expiration, but then you put aside the $37,000 you would have used to buy the stock, which if you had it, you would have bought it anyway. I understand that in this case. But holding that aside so that your risk is still 6408 off an investment of technically 43,000, and you don't touch that 37,000. You don't buy more calls with it. You don't do anything else. That's the only true parity trade to the married put, is leaving the cash aside and buying the call option. But of course, if the stock pays a dividend, I wouldn't do that anyway because I'm missing out on the dividend. Might as well get it if I can have it, again, if you have the capital. Okay? This is why usually with these higher price stocks, this is why you don't see me in the Fusion portfolio buying Apple, Netflix, Amazon, things of that nature. I trade those maybe as calendar spreads or with bull put credit spreads because same as you, I don't have the capital. But trying to force it into that in-the-money strangle position is not a good idea. It puts you in a delta opposed position, Vince. You need a wider movement to start seeing a profit. Yes, I understand you're going to be selling calls and kind of creating a calendar spread against the long call you bought with the long put in place. Not something we advocate, and in all of the experiments I've ran, I usually see a profit. I pretty much always see a profit on the married put. Doesn't mean it hit your goals, but I see a profit on the married put before we start seeing a profit on those in-the-money long strangles, okay? Let's get to Pat. He's been waiting. Pat's been waiting patiently, I should say. Pat bought 200 shares of GLD at 170.73. Excellent, Pat. And that was your first comment. And your second one is bought to open up. January 2021, 172 puts at 823. When open covered calls, what price should I look for? Bought to open the puts. Okay. All right, Pat. Bought to open puts on 720 also. It's okay. That's fine. The prices are great. That doesn't matter. Okay. So let's run your position here. Let's take a look. Excellent, Pat. So we're talking about a married put position, the radioactive trading technique. It sounds like how Pat set this up. And we were into the January 2021 172 put. 172? Okay, yeah. And that was at 8. I know you did 200 shares and 2 puts. I'm just going to use 1 and 1 to keep the math simple, Pat, okay? Add stock, 100, 170.73. All right. Okay. And the question is, when analyzing the position, what calls should I consider? Well, first off, on power options, let me just add this to our July 24th portfolio as is. Date doesn't matter. The price is due. That's all that's important. Okay. So I've entered in your married put position there as it stands. Your initial at risk on the position was probably pretty low. Okay. But whenever you're tracking a position in the portfolio, Pat, I'll go to position actions. Position analysis. This will work for collar positions, covered calls, basically any position you're tracking in power options. You'll get a breakdown of your current position. Okay, so your max risk was only 0.2%. You're pretty much bulletproof on this case. Oh, really? Okay, so it didn't. That's odd. I know why. Okay, I'll make that change again. I'm sorry about that. What it should show you is rollout opportunities, okay? And what it would do is it would show you a grid of potential income method number 1, selling to open a call against the position, rolling the put. We're going to take a look at that real quick too, as well as maybe an income method number 6. Pat, when you're considering making an adjustment to the married put position, you want to consult the blueprint and follow the rules and the guidelines for each one. Income method number 1, selling the call, has a few guidelines. Number 1, you're safe here, but the first thing you always want to do is sell a call above the put strike price. If you ever sell a call below the put strike price, then you're in a bearish position. Okay, that's a no-no, unless you're trying to simulate a bearish position. Your sentiment has changed. Okay, so you want the premium to be at least a third to half of your risk. You don't have that problem anymore because you're pretty much bulletproof on the position. And you want to stay under 45 days out in time. Not necessarily mean forcing a weekly sale for a smaller premium. But the real caveat here is that you're on a stock that's moving up because of market conditions. It's been bouncing around a little bit, but in general, there we go, we're seeing a really strong uptrend. So the first comment is it worth it for a premium of $200, $300, $400 or $500, $600, $700 with 200 shares to get in the way of the freight train right now? That's what selling a call does. You're capping your upside. Okay? So why is that important? It's important because the strike I would consider selecting of the available dates, maybe 21 or 28 days out in time, maybe even 14, but let's just go 21, 3 weeks out in time. I'm going to try to pick a strike where I think the stock is not going to hit in the next 3 weeks. Let's just say I take 185. And what was my premium? 142. So for 200 shares, you're generating $282 to do what? To get you to bulletproof position, Pat. Yep, full bulletproof position now. Guaranteed return of 3.2%, max return of 6.3%, but capping the upside at 185. If this stock continues to go up here to 182, 183, with 3 weeks, 2 weeks left to go, this call premium is still going to increase. It's going to cost you more to buy it back. Is that the structure you want? You say, okay, well, I'm going to pick a strike where the stock's not going to hit, so let me go to 190. Well, now you're talking about 70 cents. Is it worth it? Okay, let's go out further. Let's go out to August, okay? So my concern here is that if you've got a stock that's doing this, that's moving up if you think the best, okay, sorry, step back. Not really described in the blueprint, but it is in the appendix where Ernie talks about his HBQ example. My preferred time to use income method number one is if I think we've peaked and now GLD will start to come back. That's the perfect time to sell. If I think this thing is going to run and the market is going to still hesitate and pull back and that's going to cause GLD to move up, I am not selling a call right now. I don't want to get in the way of the freight train. I want to let it grow. I want to let it keep expanding. It's not worth it for 70 cents to go out to the 190 or 30 cents to go out to the 200 strike even to August. I'd be better off just leaving the position alone if it continues to move up. But if you think it's peaked and it's going to pull back, that's the perfect time to sell a call, but you're trying to pick a strike where you think it's not going to go, but it still gives you the premium that you want. And remember, you saw how this could bulletproof your position to 3.2%. We sold that 185 call for around 140, 143, 145 if you're lucky. You've got this asset here where the stock has now moved up above it. And I understand you might not want to add to the risk in the, add to the cost in the position. Well, my favorite thing to do in this scenario would be income method number 4. You still have value in this put. It didn't go to 0. It's at 620. Okay? So what if I do the opposite? What if I sell to close that for 620 and buy the 180 for 1040? What am I doing? I'm paying $4 to gain $8. Yes, it's a debit. I'm adding $4 in the position, but I'm increasing my payout by 8 points. Okay, so that gets me to a bulletproof status of 1.8%. Oh, that didn't get me to bulletproof. I apologize. That didn't get me to the bulletproof status. I thought it did, but that's okay. So now I'm at the 180 put. I've lowered the risk to 1.8. I could also go up to the 185, but now I combine the two together if and only if you think the stock is peaked. Okay? If you think it's reached its peak and it's going to pull back, you rolled the put up, you paid $4 to gain 8 higher payout, and then you sell the call for 143. You got a bulletproof position there with a 5.6% return. So that's not as great as just selling a call in this case, but that's another idea that you could do. But selecting the call, as you can see, let's go back to square one. You have to pick a strike where you think the stock is not going to go above because you have capped your gain. On a stock that's rocketing up like this, if you think you've peaked out, you think it's hit its top and it's going to pull back, that's when I would consider closing the position, okay? That's what we'd look at. All right. Yeah, and so it's the comments that come in from Sam, the market will have a hard time to go up with all the uncertainty. Gold has strong upside. You bought the GDX at 20, and this week it's at 40. Okay, that's a comment from Sam, all right? So, okay. All right. Okay. Oh, another thought there Sam offered is something you could consider there as well related to GLD. I kept it 101 to keep the math simple, but Sam offers up the thought if you wanted to generate some premium, if you have 200 shares and 2 puts there, and you could just sell 1 call. So you might be capped out on 100 shares, but you leave the upside open as well. Okay? All right. Sam's reference he also mentions there also. Oh, Vince, you're welcome. Okay, I was just sorry I got into that from the bottom side here. Okay. Yeah, it says the Apple trade is Sam's talking about the Apple there. He said he'd prefer to go longer, just buy the call there in that case. Vince, going back to the Apple, buying the call instead of the stock. Sam also feels that the Apple trade, either my married put that I was talking about or your in the money strangle that you were talking about, it could be a headache because it's too long to keep adjusting. You're going to see a lot of fluctuations up and down over that 600, 700 day time period as well. Okay. All right. Pat, hey, thanks. That's great. Pat says, thanks for the excellent discussion. I'm in a 14-day free trial. We'll start subscription next week. It was an amazing discussion. You're an amazing teacher. Well, thank you, Pat. I appreciate that as well. Okay. Okay, Vince says I intended to buy the September 220 call with a 6-month out long put. Okay, now that might work too. Just got to pay attention to that delta there in that case as well. Okay, all right.